Hello and welcome back to our second video lecture dealing with Chapter 7, which talks about cash and internal controls. So in this video, we're going to, discuss cash, and we're going to talk about how do we account for cash. So we're going to go into much more detail than we did at the beginning of class, right? At the beginning of the class, we saw how to hit our cash account for, paying for utility bills or maybe buying equipment. We also saw how to hit cash for, earning revenue, receiving, cash for revenue, or somebody paying their account receivable bill. We saw how to get cash in, how to book cash. But we're going to break cash down in this video into its components, and we'll see what components actually make up cash. Okay, so the first thing that we need to recognize is cash is just more than money, right? In layman's terms, when we think of cash, we think of currency, right? Coins, dollar bills, $10 bills, $5 bills, whatever, right? But cash includes a lot more than that. Cash includes things like checks, money orders, right? Checking accounts, savings accounts. That is also considered cash, okay? So when we report cash, we're going to see, we're going to go into more detail, right? So cash, again, we're going to report it as a combination with cash equivalents and cash. So what exactly are cash equivalents? Well, these are things like CDs, certificates of deposits, maybe treasury bills we have, money market accounts. Those are all examples of our cash equivalents, okay? Now, companies can report cash in a way that's good for management, or which benefits management. What do you mean by that? What are you talking about? Well, think about it. As owner or as investors, we're just concerned with, hey, how much cash do they have in the bank, right? How much cash do they have? Can they pay their liabilities? That's all we're concerned about, right? From a management perspective, yeah, all those things are important, right? But we also report cash that is restricted, okay? And we say cash is restricted when management deems it to be restricted, meaning we're going to set X amount of cash aside, and this money is intended to be used for an expansion project, okay? So that restricted cash is actually reported separately. So we'll see we might see 2 or 3 items in cash. We'll see cash, obviously, but then we might see amount that says, oh, hey, this is restricted cash. It's used for a specific purpose that management deems, and we'll see total cash. As investors, again, we're just concerned with that total cash, okay? So let's look at some internal controls for cash. Now, if you think back to the prior video, hopefully I didn't bore you too much, we looked at those 5 elements of internal controls that COSO said, hey, these are the 5 main components for implementing some sort of internal controls. Now we're going to take those concepts and we're going to apply it to cash. How do we set up good internal controls for our cash? Cash is the most easiest thing to steal, right? It's the most easiest thing to go missing, for lack of a better term. So because we know how easy cash is to steal, to conceal, misappropriate, whatever, okay? As a company or as a manager, we need to develop some elaborate internal controls in order for us to make sure our cash is protected, to safeguard that cash, right? So what kind of controls are involved specifically with cash? Well, we're going to look at mailroom or retail sales areas for receipts. We're going to look at the treasurer for custody. We're going to use the controller for the recording of cash. and we're going to use the internal audit process. So as you could see here, in the prior video, we talked about separation of duties. We have that here, right? Treasurer has custody of the cash, but the controller does the recording. Okay. We have mailroom or retail sales areas for receipts. Okay. So maybe we have a specific area where we count our cash or we do our cash transactions. And maybe that area is under lock and key, right? And maybe we only let certain people in that area. And maybe, well, I'm sure we're going to have a supervisor to oversee everything. Okay. So we're going to take those internal controls that we, again, learned in our last video. We're going to apply them to cash. That's it. So let's see how do we actually reconcile our bank statement? What is the reconciliation process? Now, not to scare you, but I found this area seems to give students a lot of trouble, and here's why. Excuse me. In my on-ground class, I say, hey, how many of you balance a checkbook? And I had one student look at me and say, what's a checkbook? Yeah. So checkbook has a register and has our checks in it. And we keep track of all the cash that goes into our cash account and all the cash that comes out of our bank account, right? Students say, well, why do I need that? It's all online. And I say, okay, that's cool. But how do you keep track of money that the bank doesn't know about yet? They're like, well, what do you mean? I'm like, well, what if you write a check? And everybody looks at me and says, yeah, we don't write checks. So this is a skill that if you get into accounting, you got to know. I strongly encourage you to apply these concepts and processes into your own money handling. Because what we're going to learn here, and I remember when I learned this, I was like, this is just like balancing a checkbook, right? So if you know how to balance a checkbook, you're good. If you don't, that's okay. We'll teach you how to do it. So we're going to look at the bank reconciliation, okay? And usually the reconciliation of the cash account or the bank account usually falls within the internal audit department. These are the people this is the department that reconciles the amount of cash that we have on our bank statement versus the amount of cash we have on our books. Those will differ, okay? I say I have $1,000. The bank says, nope, you have $900. There's a discrepancy there, right? Well, why would the bank say I have less than my books say? Well, there could be something like a deposit in transit. That means that I made a deposit to the bank. The bank really hasn't updated their records yet, okay? The bank might charge me fees that I didn't account for yet. That's one example, okay? There might be outstanding checks. So we're going to see each of these items and we're going to see how we apply it to a bank reconciliation. So that'll come a little later. But right now I want to kind of focus in on the primary activities of effective cash management. Now this might be a little redundant. I'm telling you right now, you probably already know it because we kind of sort of talked about the principles in our previous video, right? But we're going to see some concrete examples of how we take those concepts of internal controls and apply those specifically to cash management, right? We always want to monitor our cash, okay? We're going to have financial statements that help us do that. We're going to have the statement of cash flow, right? What cash do we have coming in? What cash did we have going out? Where did it come from, right? The statement of cash flow is also going to help us determine if cash went up or if our cash went down, meaning the balances, okay? We're going to look at cash on hand. What is cash on hand? Well, that means that we have enough cash on hand for our day-to-day operations or our day-to-day costs, right? We have to pay wages. We have to pay our suppliers, okay? So we want to have enough cash on hand to do that. We don't want to have too much cash on hand. That's wasteful for us. Why? Well, because if our money or our cash is sitting around and we have enough money to pay our day-to-day operations, right? Wages, supplies, whatever, right? If we have a bulk of money just sitting there, that money's not working for us. We can invest that cash in maybe a CD or a treasury bond, or we can invest it in the stock market, okay? So what are some important activities within effective cash management? Well, we want to manage our receivables. In Chapter 8, we'll talk about accounts receivable, accounts payable, things like that. But if you think back, what are we talking about? Managing our receivables. Well, remember, sometimes we'll sell things on account, right? We'll provide services on account. That means that we've given them the product or we've provided the customer with the service. They owe us money, okay? We have an asset, an accounts receivable. That's the right to receive cash. Well, that's great, but we want the cash behind that right, okay? Another activity that we conduct within cash management is we manage our inventory levels, right? We make sure we don't have too much inventory on hand. Why? Because if we have too much inventory on hand, guess what that means? Our cash is tied up in that inventory. We used cash to buy inventory. We have to turn around and sell it so we can get the cash back, right? If we have too much inventory, then that's cash that we're not getting back, okay? We're going to manage our payables, right? Well, what does that have to do with cash management? Well, we know what payables are. Somebody gives us stuff. We have the obligation to sacrifice assets, aka cash, to pay for those obligations, right? Well, if you think back, we learned about those when we were booking sales and buying supplies. When we were buying things on account, we said, 210 net 30, right? Are we managing our payables? Are we paying our receivables in enough time to get a discount, okay? And then investing that excess cash, that has to go with, or that goes hand in hand with cash on hand, right? Making sure we don't have too much cash on hand so we can invest that excess cash so it's making us money or it's working for us. Okay? Don't worry about the appendix A. You guys aren't going into accounting. A lot of you guys are, MBA, getting that business, just increasing your business knowledge. So maybe to run your practice or whatever, that's great. Chances are you won't even have an audit. If you do, it might be like a healthcare audit or something like that. There's really nothing you have to do. Other than get them the reports that they need. But what I want to do is I want to show you how to reconcile with me here. Show you how to do a bank reconciliation. That is the wrong one. What I'm doing is I'm pulling up our workbook. And in our workbook, you were asked to do exercise 7-3, I believe. And here it is right here. Okay? So I kind of set it up for you. The good news is that this is pretty much what you have to do, right? A reconciliation is very easy to do. You want to take your, You want to take your book balance and the balance on your bank statement, and you want to find out why they don't equal, okay? So I'm going to run through that right now real quick. Super easy to do, not very difficult once you figure out what exactly we're doing, okay? So if you look at the exercise, they say they want us to do a bank reconciliation for Young Company at June 30th. So what I'm going to do is I'm going to go ahead and entitle this, right? I'm going to say Young Company. This is my bank rec or my bank reconciliation. And they want us to do it as of June 30th. Super easy, right? Okay. So the first thing that they tell us is they give us 7 items. We have to account for these 7 items and figure out exactly what is the bank balance, or I'm sorry, what is our cash balance? What is it really, right? Because the book says one thing, the bank statement says another. Somewhere between these two has to be the right amount. So first step is to just pluck your balances off the bank statement and get your cash balance that's on your books and plug them in. That's all. So number 1 tells us the balance per cash account at June 30th is $7,039.80. I'm going to plug that in. Okay. Oh, okay. Then they tell us that the the balance per the bank statement as of June 30th is $7,300.25. I'm going to plug that in. So what is our cash balance? Is it 7,039 or is it 7,300? I don't know. Well, I can compare what I've accounted for versus what the bank has accounted for. Okay, so let's look at number 3. Deposits not reflected on bank statement was $950. So what that means is, that means that in my books, in my ledger, I said I deposited $950. The bank does not have that. The bank does not show that deposit. Why? Well, because it's a deposit in transit. I made the deposit, the bank statement came out, and it's just not on there. That's okay. That's normal. So I'm going to add that. Oh, sorry. So I'm going to add that to my bank balance. Okay. So I'm going to add $950. Okay. Outstanding checks, June 30th, $1,260.45. So in my books, I wrote a check for $1,260. Guess what? The bank does not have that check. Okay, they didn't recognize that. Okay, no problem. I'm going to put that on my bank balance. Or I'm going to subtract that from my bank balance, $1,260.45. Okay? 5 says service charge on bank statement not recorded in the books, $35. So the bank charged me a $35 fee. They took it out of my account. I did not record that in my books. I'm going to record that now. So I'm going to subtract out any service charges, $35, and we're good. Okay, let's look at number 6. Error by bank. Yertle Company check charged on Young's Company's bank account statement was $375. Basically, what that means is the bank made an error, okay? Yertle Company had a check. They charged it to us. They should have charged it to Yertle Company. So basically what this is saying is they're saying, or the bank's saying, hey, Young Company, you wrote a check for $375. We're saying, nope, that's not us. Yertle Company wrote that check. You need to take that out of their account, not ours. Ooh. So under bank errors, I'm going to add that back to the bank deposit of $375. And the last one says check for advertising expense, $260. Incorrectly recorded in the books is $620. So what happened is, on my books, I wrote a check for $620. That's what I recorded it as. But I transposed the number. The check should have been for $260. How did I find that out? Well, I looked at my bank statement. I looked at the check number. Let's say it's check number 1000. Check number 1000, $260. I looked at my bank records, or my records, my journal records, and says, oh, check 1000 should be for $620. I go back, I look at the receipt, and I say, nope. I wrote the check for the right amount. I just entered it improperly into the books. Okay, so I'm going to fix that. So the difference between 620 and 260 is $360. Okay, so here's what I'm going to do. I'm going to go to my bank balance side, $7,300 plus the deposit not accounted for, $950, plus the bank error they made, $375, minus my outstanding checks, gives me $7,364.80. I go to my bank, or I go to my general journal, and I say, hey, my bank account is $7,039.80. Well, no, it's not. You need to add that error you made. You took too much out. Okay. You need to subtract out those service charges. Okay. So what's my reconciliated cash balance per my ledger? $7,364.80. Okay. So notice the reconciliated cash balance matches both the bank side and my book side, or my general ledger side. That's pretty much how you balance your checkbook. That's how you do a cash reconciliation. Okay. If this was as clear as mud, not a problem. Just reach out to me. Let me know. We can, discuss it. Okay. So that, my friends, is chapter 7. You should be good to go to do your homework. Yeah, you should be good to go. If you have any questions, please feel free to reach out to me. I'd be more than happy to offer any guidance or help you out in any way I can. Thanks, and have a great week.